Assalamualaikum to Sir Mustafa. My name is ADRIANA ABDUL and my matrix number is IZZUDDEEN 190056. So now, I will be presenting about the introduction of Worldcom. Worldcom was a telecommunication company which is located at Clinton, Mississippi in United States. It has 20 millions of customers, 80,000 of employees and thousands of clients. So during 1983, a business plan offering long-distance telephone service was drafted. Bill Fields has established the Worldcom in Hattiesburg, MS under the name of Long Distance Discount Service, which is known as LDDS. LDDS has changed their name into Worldcom on 1995 because the company's top management has realized that the name of Worldcom is more consistent for the company's future growth strategy. So Worldcom has merged with the Microwave Communication Inc., which is known as MCI, with $37 billion on 10 November 1997. So Bernard Abel, who was the CEO of Worldcom, has become one of the richest men in United States. So the company continued the business by acquiring various of companies such as UUNet, CompuServe, and America's Online Data Network, which put the Worldcom on leading operator internet infrastructure. So next, Izzu will explain more about the introduction of Worldcom. Thank you.
Assalamualaikum. Hello to Sir Mustafa. My name is IZZUDDEEN and my matric number is IZZUDDEEN 19044. I will continue presenting about introduction. The Worldcom company, which was the world's largest carrier of internet traffic, was on the brink of bankruptcy after the company admitted a record of 4 billion failure. This accounting fraud happened when the CEO of Worldcom, Bernard Abel, and the man in charge of the finance, Scott Sullivan, accused of cooking the book on 2002. Due to their greediness, nearly 30,000 employees have lost their jobs. Worldcom was not just the biggest accounting scandal in the history of the United States. It also one of the biggest bankruptcy of all the time. The revelation that telecommunication giants Worldcom had cooked its books came on the heels of the Enron and Tyco frauds, which had rocked the financial market. However, the scale of the Worldcom fraud put even them in the shade. Next, I will present about our findings. On the year 2000, telecommunication industry has started to slow down. Due to the situation, Worldcom had terminated a lot of employees and credit rating of the company has been downgraded. This has caused a decline in Worldcom stock values from $64 to $2.65, while debt has taken on the finance merge and infrastructure investment remain, but their revenue has fallen short of expectation. As a result, the CEO, Bernard Abel, resigned on April 30, 2002. In specific incident, Worldcom's board of directors has lent $450 million from the company's office to help Bernard Abel to cover some of his personal debt. The intention was to avoid a massive sale of the company's stock, as his debt has amounted to more than $8,000 million. In order to avoid Abel from selling his substantial amount of stock in the company, the corporate loans amounted to $400,000 million has been provided for financing his other business such as yachting and timber. The situation of Worldcom became worse when its three important executives were found to involve in fraudulent behavior between 1999 to May 2002. The three executives was Scott Sullivan, who was the chief finance officer of the company, David Mears, the controller, and Buford Yates, who was the director of general accounting. The three of them had used fraudulent methods to conceal its declining financial condition by giving a wrong picture of financial growth and profitability of the company. This was done with the intention of raising the value of the stock prices of the company. The fraud was committed in two ways, by reducing the reserve account and also under-reporting the expense. That's all from me. Next, Alya will continue explaining about our findings. Thank you.
Assalamualaikum to Sir Mustafa. My name is Nur Syaherah binti ZAWAWI. I am UDE 190059. So I'm going to continue with what Izzu have mentioned before, and I'm going to present the accounting fraud that have been used by Worldcom. So the first one is reserving accounts. The reserving accounts activities was committed when the operating margin of the company showed that the financial gain is steeply declined in 1998. Executives made the company's profits increase by using the fraudulent accounting entries from the corporate unallocated revenue accounts. The company has reduced the reserve accounts held to conceal the liabilities of the acquired companies by added $2.8 billion to the revenue lines from the reserves. As a result, the profit margin of the Worldcom had increased constantly in 1999 and 2000. However, the accounting manipulation was insufficient to maintain the profits of the year 2001. The operating margin decreased to less than half compared to the previous year's profits. So the second one is the underreporting expenses. In order for the company to boost their stock price, the accounting department of the company has underreported the line cost, which is the interconnection expenses with other telecommunication companies. The company had loss of $649 million in the year of 2000, but by using the account fraud, they recorded the profit of $2,608 million. The company reported them as the capital investment on the balance sheets rather than properly expensing them to show that they are spending less and making more money. Part of the current expenses was transferred for a capital account. In such a way, Worldcom has boosted its net income as expenses were understated and its assets as capitalized costs are treated as investment from 1999 to 2001. Worldcom kept off balance sheet by capitalizing the line costs rather than expressing the expenses immediately, and hence the loss of $1 billion. So I'm going to pass it to ARISYA to continue with the discovery of Worldcom's fraud. Thank you.
Assalamualaikum to Sir Mustafa. My name is Sharifah FARHANA binti Syed MUNAWAR. My metric number is UDE 190083. So today I will be presenting about discovery for Worldcom. So the first one is discovered by an employee, Cynthia Cooper. So Cynthia Cooper was the America's second famous whistleblower, and at that time there was a spot check running. So Mrs. Cooper, who was employed as an internal auditor for the company, was asked by John Sidgmore, who was the new chief executive, to check all the spending records for the company. And at that time, the founder of the Worldcom, which is Bernie Ebbers, was the CEO, and then it was obviously that the company slashed spending equipment and telecom services. At that time they were using accounting trick to preserve the appearance of constantly growing profitability. And then it was revealed that Ebbers has borrowed money from the Bank of America, and at that time he borrowed for almost 400 million USD in 2000. And it was done to cover margin calls. And then, for instance, the Worldcom actually inflated its net income and cash flow by recording as investment to hide the profitability. And then it was discovered that they were maximizing their expenses as it magnifies profits. So they were actually hiding their investment to the falling profitability, which was not considered as sophisticated fraud. And next, later, it was found that they were ignore memos from Worldcom executive. So Anderson, who was the auditor for Worldcom, who was previously the auditor for NAJWAN, Anderson it has ignored the memos from the Worldcom executive. So they were told that the company's profit was actually inflating by indelicate accounting for expenses. Thank you.
Hi, Assalamualaikum to Sir Mustafa. My name is Muhammad Izzat Today, and my metric number is UDE 190051. Today, I want to talk about materiality concept. So, what is materiality concept? Materiality concept is misstatement or omissions of financial information, either individually or in the aggregate, that may influence or affect the decision made by the users of financial statement. So for the Worldcom company, the accounting scandal that protect their bankruptcy to save the company by using the easy way, which is fraud. And we can see in 1988, Worldcom company has added 2.8 billion to revenue lines from the reserve. And after 2 years, the company had lost 649 millions, and the company has decided to took the book for avoid their losses by recording the profit of 2,608 million in the year. It is reported them as the capital investment on the balance sheet, and it shows that they are spending less and have more profits.
Hello sir, my name is PRAVENA Suresh. My metrics numbers are UDE 190076. So now I'm going to present about audit risk mode. In this, Worldcom scandal has left a lot of headway on this company, and due to these scammers, almost 13,000 workers lost their job. So we can assess the scandal of the Worldcom company with the audit risk mode. Audit risk refers to the risk that the auditors may issue an unqualified report to the auditor's inabilities to distinguish material mistakes, either because of mistakes or extortion. There are three types of audit risk mode: inherent risk, control risk, and detection risk. So, inherent risk is the risk that cannot be covered or detected by an entity's internal controls. Inherent risk can occur in finance audit in the event of surprising exchanges or a high valuation of money-related valuation. In this case of Worldcom scandal, operational expenses must be deducted from income immediately, while capital expenditures can be spread over time. The inherent risk factor of the Worldcom was found to be due to complex of their transactions. The same applies to this inherent risk, which cannot be overcome by naturally of the risk but can reduce slowly. Control risk is the risk that material misstatement will not be prevented or detected by the internal control. So in this case of Worldcom, the company filed a bankruptcy in year 2002 as executive inflated the company asset with fraudulent accounting entries and $11 billion in dubious accounting by high-ranking workers in the industry. Hence, the factor of the control risk is lacking of internal control by the Worldcom company authorities is the causes of company scandals. The risk assessments of the control in this Worldcom business may be higher because of role segregation is not specified here.
Next is detection risk. Detection risk is the risk that the auditors neglect to distinguish a material error in the financial statement. And in the Worldcom cases, the accountant and auditors failed to detect the problem, and Worldcom had to deal with a huge bankruptcy. For example, an accountant in the Worldcom company, which is Arthur Anderson, who also handled the Aaron's book and other accounting firms, has accused Mr. Sullivan of camouflaging the company's accounting information. So in this case, the risk of detection can be minimized by the auditors by expanding the numbers of exchanges examined for detailed testing.
Hi, my name is RAFIQAH. So today I will be presenting about Worldcom's conclusion. So we can conclude that Worldcom was one of a large proportion and it made a history in finance and also telecommunication areas. Besides that, Worldcom case was not only about greed. Instead, it is about a corporate culture that fostered dependent workers with low self-esteem who will not exercise free will and who perform for external rewards. Then, Worldcom was preventable if all parties uphold high responsibility and integrity. Therefore, more responsibility and integrity should be upheld. Lastly, the government needs to investigate truly to prevent fraud from happening. That is all from me. Thank you very much.